So thanks for tuning into the Journey with Christian Davis podcast, where we talk to amazing, cool people doing amazing, cool shit. And one of the reasons why I want to have this guy on is because he's the CIO, the Chief Investment Officer of Bitwise Asset Management, which basically what he just told me offline is they scaled from basically $1 billion to 7 billion, 12 billion now within a very short period of time frame. And one of the reasons why is because crypto is on everybody's mind. And one, obviously, family offices, high net worth, ultra high net worth, with the retail investors as well, understanding how do we navigate this. And that's why we have this man on. I'm so excited about having him on. Please welcome my next guest, the one and only Matt Hougan. Matt, how you doing, man?
Christian, I'm so glad to be here. What an introduction. It's an honor to be on. Really excited to speak with you about what's going on in crypto, what's going on at Bitwise. It's going to be a lot of fun.
Matt, it's going to be really interesting because I want to start a little bit about, everybody's a hindsight bias, right? We can all say, oh, yeah, we knew, Bitcoin is going to go to XYZ, 100,000. We knew this was going to happen. But at the end of the day, when you were in it, 2021, 7 years ago, whatever it was, did you see kind of the trajectory that it was led to where we're at now? Because it's been a journey for you guys. And so I'd love for you to just talk on that a little bit, and then we'll dive into some more specific topics.
Yeah, it's definitely been a journey. And I'll say, even though maybe I'm early to crypto, I joined Bitwise in 2018. I had the same, early skepticism. I first encountered Bitcoin, I think, back in 2012 or 2013. So it took me a long time to get around it. I think I saw a very positive path for Bitcoin. I saw sort of a manifest destiny for where it was going and its role in the world. But we've gotten to where we are faster than we thought. And particularly in terms of how governments around the world are sort of bending into the Bitcoin orbit has surprised me to the upside. So I knew we were on a positive journey. I thought that we would have really substantial returns. But the speed at which we've gotten there, particularly over the last 2 years, has exceeded my expectations. And I actually only see it accelerating from here.
And so what's also interesting, of course, is we're looking at the holistic aspect of, all these different kind of coins, if you will, right? Whether it's Bitcoin, which is obviously very well known, stable coin, whatever these other stable coins as well. How do you guys think about this? Because we're seeing some where there are fraudulent coins, right? There's this huge kind of momentum stuff, and then obviously people pull money out, and it kind of reminds me of just a cash and burn kind of situation. How do you guys navigate that, and what are your thoughts in regards to kind of the way you think about that?
Yeah, great question. You should think about this like any other economy, right? Here's the thing. Crypto is its own economy that's been growing financially extraordinarily fast, 100% year over year compounding returns. Anytime you get that kind of extreme acceleration and rapid returns, you get some fraud and some negative tech activity that comes along with that. That's been true before crypto and other industries. It's certainly true in crypto. What we do at Bitwise, we've been doing this for 7 years, is take a deeper look at these assets and evaluate them on a series of risk metrics to try to screen out the nonsense. We ask ourselves, is the fundamental underlying security architecture secure? Are these assets likely to be in violation of major federal securities laws? Are mainstream institutions, usually that are regulated in the US, adopting these assets and bringing them onto their balance sheets? Is there a fundamental economic use and fundamental users accessing this product and the underlying blockchain? And if it checks all that tabs, we deem it investable. I'm not sort of just talking in future tense. We've been doing this for 7 years in our core product, which is an index-based product, sort of the S&P 500 of crypto. And through the years, we've used these tools to avoid assets that have gone on to blow up. You might remember, Christian, a stable coin called Luna that grew to $60 billion and then completely collapsed. We avoided that. You might remember FTX, which had its own token, FTT. We screened that out of the index. So if you take this simple rules-based approach to screening out the junk, you end up with a bunch of assets that are investable. That doesn't mean they're all winners. We've certainly owned some assets that haven't caught traction in the market and have fallen out of favor. But it does mean that you can at least try to avoid some of these blowups. And I think your big point is important. Crypto is a diverse space. There are high quality projects like Bitcoin, Ethereum, Solana, etc. And then there are scams and assets that you need to avoid. And you need to be able to tell the difference between the two or find someone that can help you do that.
So important, like you said, where you have that criteria, that deep level filter. And like you just mentioned, FTX and then Luna as well, those obviously pushed out of your filter because of obvious reasons, which I'm glad you're probably thinking about this. I am curious on this because one of the questions I had, I reached out to some of my other investor friends and some of the questions that they wanted to ask you. And one of the questions he said is, how should investors navigate concerns around high volatility and the speculative nature of many crypto assets? Which I thought was very, very powerful because it seems like it's a uncorrelated asset to the S&P. It's uncorrelated to real estate. It's uncorrelated just like holistically. It's a very just interesting kind of nature. So I'm curious, I'd love for you to just talk on the volatility and the way you guys navigate this and buying and selling, being very active.
Yeah. I mean, the first thing I would say is you could think of volatility almost as your friend as long as you do your position sizing appropriately. Where people get in trouble with crypto is when they make it 10, 20, 30, 40% of their portfolio. And then it has a 50% drawdown and they feel that in their gut and they panic and sell at the bottom. Those are the investors who have been sort of lost in crypto and have been very painful experiences. If you size your portfolio appropriately, which for most investors, you're talking about a 1% to 5% allocation to crypto. That's what we see. BlackRock recommends 2%, others recommend 3%. 1 to 5 is sort of the sweet spot. If you have 1% of your portfolio in crypto, Christian, and it falls 50%, you've lost 50 basis points. So what? Right? The S&P 500 goes up or down 2% in a day all the time. We don't panic. The real key with volatility is number one, not to panic and sell at the bottom or to chase returns at the top. And two, if you're disciplined, you can rebalance using that volatility and turning it into your friend. In other words, say you're going to invest 1% of your portfolio. If it drops to 50 basis points, re-up to 1%. If it rises to 2%, sell and bring it back down to 1%. And when you do that historically, you get this beautiful effect in a portfolio, which is it improves your overall returns, but it doesn't increase the volatility of your portfolio at all. So position sizing and then discipline can turn volatility from a challenge into an asset. And you actually get a really interesting effect on your portfolio when you do that.
So that typical investment strategy you have over here in the stocks to bonds ratio, you can obviously also deploy that same strategy in regards to the diversification, but also that dollar cost averaging approach and that discipline approach in the crypto space. I did want to ask you this, because the institutions recently got involved with this space holistically. I think that was actually earlier this year, if I'm not mistaken, and which was really good to see that. Have you seen more of a foundation built or like a sustainability in the market by having the institutions? And how do you think that has either beneficially benefited the market or negatively impacted the market?
Yeah, it's a great answer. We're seeing massive institutional adoption. The primary catalyst was the launch of ETFs in the US, which happened almost a year ago, right, in January of 2024. And then you had other catalysts as well, including the November election, which made it sort of safe to add crypto to a portfolio. So we are seeing these institutions coming in. It's having a very positive aspect or effect on the market. It's doing exactly what you would expect. The volatility of Bitcoin is falling because you have more diverse kinds of people buying and selling the asset for more different reasons. When it's only retail chasing this asset, you can get these big swings up and down. But when you have these institutions that do disciplined rebalancing, the volatility is squashed. And actually, right now, the volatility of Bitcoin is below the volatility of the Mag 7 stocks. So it's still very volatile, but it's not as volatile as Nvidia. It's not as volatile as Meta. You already own assets that are more volatile than Bitcoin. And the reason is that these institutions have come in. I think that's going to continue and accelerate over time. It's still going to be more volatile than gold. It's still going to be more volatile than like the Dow because it's a new disruptive technology, but it's not as volatile as maybe most people used to think. They thought of it as this crazy thing. It's now sort of like the Mag 7, like a volatile asset, and that trend's going to continue.
So because of the institutional money, it's been able to, that volatility is still there, but in comparing to obviously other asset classes, at the end of the day, it's still very comparable. And I think that's very interesting to see that. You mentioned something earlier on in regards to obviously November election, And we, this isn't new. Everybody's familiar with obviously the Biden administration focus on the way they handle, crypto assets versus obviously what Trump has done and what he probably will most likely do. In regards to Fed policy or maybe just the market in general, it seems like there's more of a bullish outlook now with the new administration coming in. What is your perspective on um, navigating this market with the
Yeah.
kind of the bullish response?
It's such a massive change. It's hard if you haven't operated in the crypto industry to know how oppressive the regulatory regime was, right? We had lawsuits coming in from the SEC at record rates, most of which failed in court, but still created this sort of aura of risk around the asset. You had a White House that wouldn't let banks touch crypto in any way, shape, or form, wouldn't let them custody it, even though Bank of New York Mellon and State Street wanted to get involved. And you only had a few brave traditional companies willing to do something in Bitcoin and risk the regulatory sort of wrath that could fall from that. You had BlackRock finally stuck its neck out. A few others like Fidelity stuck their neck out. That's completely changed, right? Under the new administration and particularly the new Congress and the new leaders that are coming in at the SEC, they're supportive of crypto, not just neutral, but supportive. So we've gone from sort of massive headwinds to what will be really significant tailwinds. From an asset manager's perspective, it means a few things. It means we can build more and better, easily accessible products, right? I mentioned the launch of Bitcoin ETFs, which really started to open up this market, but we still don't have some fundamental investment primitives that most people want to gain access to the space. In your world, I would guess that a majority of investors, or at least a large number, gain access to equities and bonds through index-based products. And then they add alpha strategies on top of that. But the core is index. There's no index-based crypto ETP, as an example. So from an asset management perspective, introducing ideas like that are going to help sort of make it easy for investors to access the space. And then educating people on just how important this shift is and how fast the world can change in crypto next year is a big part of what I do every day.
Do you see the demand for this now that obviously it's got a more of a bullish approach? Obviously, we're seeing more access to it, which is good. We're also seeing institutions coming in at a higher level. And we're, like you just mentioned, it was more oppressive under the previous administration. And now, kind of what's going to happen here. How do you think that's going to affect the market? And what I mean by that is, do you see, Bitcoin running up to, 200, 300 or whatever? Do you see some of these assets almost creating a bubble, if you will? In the private markets in 2021, we saw and I'll just name a name, Klarna, was valued at 30 billion, took a huge haircut, 80% haircut, down to like 7 billion. We saw a lot of assets in 2021. And so I'm curious if we're going to see that kind of same approach because there's so much bull, because there's so much momentum and so much money flowing into it, maybe excitement. I'm curious, just as making sure that you guys have a good entry value when you're looking at these assets, and obviously you don't want to obviously invest into something overvalued. So I'm
Yeah,
curious how you think about that.
I think it's a really good call out. I absolutely think we're going to, my base, I could be wrong. It's not investment advice, but my base case is we're going to get a runaway bull market in crypto in 2025 as we see the impact of the new administration and the ETFs and institutions coming into the space. I mean, we're seeing already governments around the world talking about buying Bitcoin on their own balance sheet. There's not that much Bitcoin to go around. So I think it could easily rip upwards. Bitwise's prediction is it'll trade above $200,000 this year. Alliance Bernstein said 200,000. Standard Chartered said 250,000. But you make a really good point, Christian. If we get that and we get people FOMOing into this asset and the momentum gets too steep, you're going to see a major retracement. I wouldn't be surprised if we ran up to $250,000 if we had a 30, 40, 50% pullback in that price, because that's just the nature of what happens during ebullient bull markets, right? Massive up, pullback, and rebase. I think that will happen. I think one thing that could mean for investors as they allocate is they can think about things like dollar cost averaging. instead of doing an all-in-one investment. They can think about things like legging into this trade over years, actually, right? If you think Bitcoin and crypto is a 10 or 20-year trade, do you need 100% of your exposure today? Maybe not. Maybe it's smarter to think about getting a toe in the water now and then doubling down next year and then doubling down next year, right? That's how the largest pensions in the world are eventually going to move into this asset, not all at once. So I think you call out something really important, which is we're set up for a big bull market, but there'll likely be over exuberance and then maybe a bubble and then a pullback, and you have to be wary of that. Particularly in the smaller cap assets. Bitcoin is probably a bit more stable, still very volatile. But as you go down the chain to asset 10, 20, 30, those could have big run-ups and then 80% pullbacks. And you have to understand that as an investor.
So are you guys, and outside of Bitcoin, right? Because I want to talk about those other small cap, I would say small cap kind of cryptos, if you will, coins. You mentioned in your book here several approaches to value in crypto assets, such as stock to flow and cost of production. So with that, which model do you think holds the most promise and why?
Yeah. So outside of Bitcoin, which has its own model, which we can talk about if you're interested, I really like to almost approach these new blockchains like traditional businesses, which I know sounds sort of funny, but if you think about something like Ethereum, which is a programmable blockchain, and their applications built on Ethereum, like trading tools or NFT minting tools or AI agents that do things. When you use those assets, you pay a fee in Ethereum. And so you can actually look at an asset like Ethereum and say, it's doing $10 billion of revenue a year, right? That's how much people are paying to use the blockchain. What's the right valuation for that? Maybe it's 20 times annual recurring revenue. Maybe it's 30 times. Maybe it's 40 times. But we have valuation models on how to value software businesses. Ethereum is just a different kind of software business. And I think applying those same kind of revenue multiples and valuation multiples is probably the closest way to value many of these non-Bitcoin assets. Bitcoin doesn't have this asset aspect because it doesn't have the same fee structure. But Ethereum, Solana, and these other assets have almost discounted cash flow like models that you can use to establish valuations. Now they're early stage, so you're going to get a wide array of outcomes depending on what inputs you put into that model. But the models will tell you that the valuation of Ethereum, which is maybe trading at $3,500, it shouldn't be $100 and it shouldn't be $20,000, right? The model will tell you it's more reasonable than that. And I think that's a very good basis to think about long-term valuation in this space.
So let's dive into this because I'm very intrigued with this, and this is something that's always been confusing to me. You buy a ABC coin at $10, right? But what does that mean, right? And I think you were the first one out of everybody that I've talked with that maybe had like a strategic approach in the way you thought about this, and it relates it to because like in our private equity arm of our family office, we are doing some buy and build structure, roll up structure. And with that, obviously, we're looking at discounted cash flow models, we're looking at free cash flow, we're looking at the financials, and we're also anticipating, okay, what would be a good entry multiple, and is it overvalued, et cetera, right? There's a lot of that is determined off those financials and in those inputs. And
Yep.
so, just like you mentioned, you're also looking at these assets and saying, okay, look, and let's just go with Ethereum because it's very well known. So you were mentioning, obviously, they've got good cash flow. Cool, wonderful. And because of that cash flow, we also see their recurring revenue structure. Okay, wonderful. They're doing XYZ, their gross margins, their EBITDA margins on this as well, their operational expense. And that's the way you think about it. And then that also correlates to the sustainability of the price of where they're at. I'm curious, how is that correlated though? How are
Yeah.
you determining? And is it just the same similar, like if I buy SpaceX right now, it's $135 a share because of XYZ. Is that kind of the same similarities in regards to
Yeah,
stock
yeah. I
price?
love that you framed it that way. That's exactly right. I think very few people understand this, but to get at why it's tied to it, the way it works is close to, but not exactly like a stock buyback. So if you look at something like Ethereum, let's say that there are 120 million Ethereum in the world, right? That's equivalent to saying there's 120 million shares of company A that exist. 120 million Ethereum. When someone wants to use an application that exists on the Ethereum blockchain, a stablecoin, a trading tool, etc., they pay a fee in Ethereum. Let's say they pay 0.01 Ethereum to use that application, in the same way you might pay a fee to use an app on your iPhone. What happens to that fee is it's burned, and it reduces the amount of Ethereum that exists in the world. So instead of 120 million Ethereum, there's 120 million minus 0.01 Ethereum. Now, a little bit of Ethereum is created every year, about 1%. But if enough people are using applications built on Ethereum, the total amount of Ethereum that exists falls. It goes from 120 million to 119 million to 118 million and on down. And that makes the existing Ethereum more valuable. So you can use that to generate something akin to a dividend. It's not a dividend in that they're not sending you cash. It's more like a stock buyback in that the amount of Ethereum that exists is going down. And so that's how that mechanism works. But if you zoom out, it's just like any other company. The more people who use the software, Ethereum, the applications built on Ethereum, the more valuable Ethereum is, because the supply of Ethereum is falling. The fewer people who use it, the less valuable it is. That's just like any other company that you're looking at in your PE business. The more people who use that service, the more valuable. The fewer people who use it, the less valuable. I think that surprises people because they think there's no cash flow. But these things are doing billions of revenue. They're burning billions of dollars of Ethereum because people want to use this service. And just because it's called crypto doesn't mean we have to discard everything we know from traditional finance. You can use those same things to evaluate this, and you get to very interesting spaces.
That is so well said, and I appreciate that. Are you guys integrating AI to run these models to identify maybe some good, for your ETFs, maybe, identifying some good entry points, and then maybe also integrating some, good stop loss structure so you mitigate that risk?
Yeah, I love it. It's a great question. So far, what we've done, we have a strategy that we use in some products called Trendwise. It doesn't use AI. It uses a fairly simple trend following strategy to attempt to decide when the market is favoring these assets, when they're not favoring these assets. It's based on some academic research, which shows, and this won't surprise you, that momentum exists in crypto. I feel like saying that is like the most obvious statement in the world. Of course, momentum exists in crypto. So you can use that to time your entry and exit points. I love the AI idea. I'm on the board of an AI driven investing company that's doing some very interesting research in and around that. We haven't applied that into Bitwise yet, but I wouldn't be shocked if we looked at it. These sort of modern AI's ability to ingest a huge amount of information and make intelligent entry and exit decisions is really fascinating. And as I mentioned, I'm close to it through this other company that I'm involved with. I think we'll eventually bring it into Bitwise in some way, shape, or form.
So when you're underwriting this, in regards to an asset, right? Let's say Ethereum, okay, and you've identified, all right, look, it's good at an entry point of 3,300, right? Let's just keep it simple, 3,000. It's at 35. Are you long-term investors, or are you using more of a very activist approach, or not an activist, more of an active approach per se? Are you coming in,
Yeah,
buying it? Obviously, got to stop loss, et cetera.
it's great. It's a great question. We have all three disciplines at Bitwise. So we're a traditional asset manager. We have a beta business, which just buys. It just buys. Like we have ETFs that all they do is they buy Ethereum. And that's just a service to investors. If an investor wants to buy that ETF, great. It charges a very low fee. Then we have strategy-based products, like I mentioned, this Trendwise strategy that time the market in and out, because many investors want to have the idea that something is doing this in a rules-based basis with no emotion based on historical research, and we run that as well. We also have an active part of our business that does more subjective overlays and looks at many more inputs into the space. Our view is at Bitwise, we aim to be sort of experts on crypto. And whether you want beta, strategy, or alpha, we want to be able to offer that to you. It's sort of different strokes for different folks. Depends on the level of volatility that you can accept in your portfolio, which of those three paradigms is right for you.
Yeah, that makes perfect sense in regards to the structure. It's interesting. I had a friend of mine, and they're very active, and they use an AI machine that's able to identify and bring in so much data and so much information. And they're able to basically articulate, okay, hey, buy ABC company. And this is more of a public market approach, but they also leverage it in their private alternative investing strategies as well. But I mean, obviously, what's interesting about this is that they say, okay, look, let's buy ABC company at $12 a share, but then all of a sudden a press release comes out within 2 days or something like that, and the share goes down, and then they have a very quick stop loss. It's already integrated into their system, and so it automatically says. And what's unique, why I say this is because one, what he was talking to me about is that the AI is more strict on the stop loss, right? Unlike
Hmm.
us, where we're more emotional approach. And one of the reasons why I say that is because when you're underwriting these assets, and I think it's so cool because you're not underwriting it just as a pricing. You're underwriting the company itself as well, and the sustainability of the business. And you mentioned, of course, you already have that deep developed criteria on sustainable, like stable coins and these things that are in play. I am wondering in regards to you know it is being overcrowded right now. Do you see that as just the competition is just what it is in regards to more of these coins being I guess produced or developed or whatever? I know you have a criteria and a filter, but obviously as XYZ amount produce more in the pipeline, and then some of them actually do get to sustainability, just like a startup. Um, what is your perspective on that? Is that something of a concern, or is it diluting it, or is it just looking at the public markets and saying you got you got Microsoft and you got Spock, you got you know Dell, you got XYZ, right? There's all these other different companies that we can buy and sell, etc.
Yeah, that's exactly right. I think of it a lot like I think of the software space. So I like the analogy that you made. If you think about the software space, we have these giants that have been here forever. We have Microsoft, we have Salesforce, we have Oracle. They have a lot of advantages. They have huge network effects, they have huge balance sheets, they can buy half of OpenAI, they can do all these things. They're real benefits to being big. And then you have a billion software startups, right? Everyone and their brother has a software startup in the garage because you can start one with 3 people. Now with AI, you can start one with like 1/10 of your time. So there are a billion startups. Most of those startups fail. Every once in a while, there's one that goes supernova. There's a Snowflake. There's a Slack. There's name your favorite recent huge success. And the same thing is true in crypto. So you have a few big giants. You have Bitcoin, you have Ethereum, you have Solana. They have huge advantages, massive network effects, huge distribution, huge brand, regulatory recognition. They're going to be around forever. They're going to be very successful. And then you have this huge number of startup coins, if you want to call them, because they're incredibly easy to launch. You and I could, they're open source software. So you and I, Christian, we could launch one in the next 30 minutes if you wanted to. Um, and most of those will fail and go to zero. And then every once in a while, you're going to get one that goes parabolic, right? Last year, Sui was a coin that went from relatively unknown to up 600%, has huge VC investment, huge interest, and appears to be on the pace of going parabolic. So your job as an investor is to figure out ways to avoid as much of the stuff that's going to fail out of that churn, but not be so ossified that you say it's only ever Bitcoin and Ethereum, right? That's just not the way technology works. It wasn't only ever Microsoft or only ever Google or only ever Salesforce. There's always innovation. That's going to be true here. And so you just have to be nimble enough to let the churn happen and keep an open mind that there's going to be these periodic risers, and then find disciplined ways to buy them early, but not so early that you're gonna, at least that's not my skill set. My skill set is not so early. I can't tell. It's impossible. But you can start to see them when they start to go parabolic, and that's probably maybe the most interesting entry point as a crypto investor.
Yeah, I mean, you think about just like the private markets where you're looking at, okay, early stage, where there's no revenue, there's no product market fit, there's no the team, whatever. It's hard to really guess it. It's just kind of, hitting, spaghetti against the wall kind of approach. But when you're
Hmm.
obviously more later stage or down the river a little bit, down the stream, you're able to identify, okay, now they've got revenue, now they've got, profitability. Now all of a sudden, so it's the same kind of thought process. And so that's where you guys focus on. I appreciate you just sharing kind of that approach. I want to ask you this. A little bit more of a macro approach. I
Hmm.
get very excited about this because in the private markets, at Pex Force, we're looking to, getting exposure in Latin America and India and other markets. And one of the biggest concerns that I've had conversations with in-house on the team, as well as with other family office friends of ours, is just the currency exchange manipulation sometimes. And we want to get exposure to these regions, but at the end of the day, we also understand that um, you have that currency exposure, right? One of the things that I found unique about using the crypto USDC or of some sort of other stable coin, you're able to mitigate that actually by like tremendously. And so we've been in conversation with some other individuals that have used that kind of strategy. We haven't done it yet, but we're obviously really for the Q1 of 2025, we're very aggressive in that. And I want to just ask, like, one, how that's going to affect the market, maybe just in the public, but also the private markets, but also you're seeing more accessibility. We're seeing more ability to move money. There's been a lot of regulation around that. You mentioned this a little bit in your book and how it's may or may not, this whole industry will totally change the financial fundamentals and financial infrastructure that's already established. So I wanted to get your perspective, just more of a macro trend of what we're seeing, maybe just outside of the crypto, but how we're utilizing it.
Yeah, it's. I'm glad you mentioned that. Glad you mentioned stable coins, sort of digital dollars on a blockchain. I think they're going to completely change the world. We have a huge privilege here in the U.S. that we don't have a great currency. We went through some inflation. We have a lot of debt, but relative to most other countries, we have a pretty good currency, right? The vast majority of the world lives in a place where the inflation rate is double digits and there's shocked out devaluations all the time. It makes investing very difficult. You can make a great fundamental investment, but get wrecked by the currency. It makes business very difficult. It's extremely hard to move money in many of these emerging market economies or to conduct basic transactions. Stablecoins are like an incredible killer app. With a stablecoin, you have effectively a US bank account in every cell phone everywhere around the world with access to dollars and the ability to move money almost instantaneously at extremely low cost. And I know when I say that, some of your listeners may be thinking that's sort of pie in the sky future. But let me make you give you an example of how very real it was. Stripe earlier this year, or I guess it's last year since it's 2025. I still haven't gotten used to that. In 2024, Stripe made its largest acquisition ever. They paid $1.1 billion for a stablecoin infrastructure provider called Bridge. What does Bridge do? Bridge makes it easy for companies to use stablecoins to establish financial transactions in many markets. Its its largest customer is Starlink. Why does Starlink use Bridge? Because they have customers in 150 countries. How are you going to set up a way for 150 people to pay you monthly for your internet? You're not. And if you did, you'd have 130 terrible currencies and then 20 decent ones. And no one wants that. As the world gets more global, being able to use stable coins for those payments makes it easy, frictionless, immediate. You can set it up tomorrow. It's I think it's going to be a complete game changer. I think it's going to open up global opportunities for businesses that historically would have built one country at a time will now be able to build, let's say, pan sub-Saharan Africa with the push of a button, or pan Latin America with the push of a button, right? Try setting up a financial banking relationship in Mexico, Costa Rica, Colombia, Peru, Argentina. Like, good luck. Get back to me in 2030, right? But with a stablecoin, you can do it instantly. And so I think recognizing that this is a sea change in how companies can build in these markets is really important. I think you'll see companies scale faster because they can roll that out without that sort of overhead. Um, and I do think most investors in the US who are not familiar with these markets underestimate how much removing that friction will do. I think it's really substantial. And again, it's happening right now. That Stripe example shows you how important this is to the future of payments globally.
Hmm. And the Starlink aspect, I mean, that is huge, huge. And just like obviously that same case study multiplied by 100 or 100x basically on each one of these companies. I mean, you think about just the international approach of this. And what I also think about this, I want to get your perspective on this because you also mentioned like smart contracts and how that's going to also impact it. And what's unique is at the macro level right now, we're seeing a lot of IPO kind of stagnant, and it's very stagnant right now. There's a lot of these companies that are private, and they've been private for many years. There's a lot of investors that are looking for liquidity. But what's unique about this space and leveraging smart contracts or crypto and integration blockchain itself as a technology is it almost removes its whole aspect behind having to go IPO, right? The whole reason why we want to have IPO is because it streamlines that whole, buying and selling. Right now, you're on a platform. It's more regulatory. Now everything is open, etc. However, though, what I'm noticing is by leveraging some of this blockchain technology or smart contracts, you can almost integrate it into the private markets. You can still be very transparent. There still can be regulation around that, but now it's like we're seeing that whole financial paradigm itself almost switch. I want to get your perspective. Are you seeing that as potential, a trajectory, or do you think that's going to be um, more of
Apologies.
like 10 years, 20 years? What is your perspective on that, Matt?
No, I think it's a big deal. I think it's happening right now. I think of it as nature repairing itself. So, right, we used to have the public markets that were relatively open, and the burden to going public was significant, but it wasn't impossible. And we had a slow increase in the number of public companies. Private companies had an exit, they could access liquidity. But the regulatory burden became so large to go public that you started having companies just decide it's not worth it, it's impossible, it's too difficult. And we've seen the total number of public companies in the world shrink over time. That's ridiculous, right? That's bad. It's bad for the economy. It's bad for the velocity of money. It's bad for the velocity of investment. It's bad for liquidity. And so, one of the things that I think we're going to see and are already seeing is blockchains, as you said, lowering that access to liquidity, bringing down the cost of being public and the cost of accessing that liquidity, and offering an alternative route for companies that don't want to go on the New York Stock Exchange. We're starting to see that on the edges. Coinbase, as an example, is talking about offering a tokenized version of its own stock through a blockchain based rail. We're seeing internationally many people accessing traditional equities in that format. I don't think it's going to happen all at once. I'm not, one of those crypto zealots who say that, NASDAQ will disappear in 3 years. I don't think that's realistic. But I do think of it as this other liquidity or this way of releasing this pressure that's built up because the cap has been on the public markets for so long. There's pressure building up and the regulation will not let it release. And this is like a natural release valve. And so I think people who are looking at the space and understanding it will have a unique opportunity to access these investment opportunities that won't be available in the traditional markets.
Yeah, what's also interesting, like you said, in regards to, like for example, let's just say SpaceX, because I think that's a very reputable company. A lot of people are very familiar with it. It's a private company, and it's valued currently at a very like what I saw, 135 billion or something like that, from what I saw recently in that public article. It's not something that we. But anyways, one of the things that I found interesting about SpaceX is that here if they integrate this into their system, now all of a sudden for the employees that are working there that want some liquidity, right? They don't have to wait until a tender offer. They don't have to wait to a certain period. Now all of a sudden they can buy and sell. But also, like you mentioned, what I'm noticing in regards to potentially, and this might be something that I've seen, where an accredited investor, right? Only accredited investors could get access to the public market, right? You have to have assets of 250,000 or more, whatever, and that's an SEC guideline, et cetera. But what's interesting is by being able to democratize that even and allowing some of these people to play in the private markets. One, there's a larger pool of capital now, but also you're able to get access to this stuff and you don't have to go, and you have still as a private entity, you have more control over it. So it's a very unique situation. I'm not saying this is going to happen in 10 years. I'm not saying that that's going to happen with SpaceX. All I'm saying is very interesting to play it out. and see what the opportunities could work out. And also look at it coming back to the geopolitical structure almost. You're getting access to some of these individuals that live in Europe, getting access to the U.S. economy, and vice versa, where we already have access to those other economies, but being able to streamline that process, leveraging these crypto assets and stable coins.
Yeah, I think that's exactly right. One of the things I like to do is I say this from time to time. Think about things that exist in the world that shouldn't be true, and it just shouldn't be hard for people around the world to access the opportunities in the U.S. And it shouldn't be as hard as it is for us, which is still somewhat difficult to access opportunities abroad. These are just digital bits of information that can surf over the internet. It's not hard to text someone in Finland anymore or in Argentina, right? We have WhatsApp. Why is it hard for them to invest in our stocks and back and forth? And, blockchains enable that. Blockchains are how money and property can move over the internet. Previously, the internet can move voice and text and video. Now it can move money and property. Those things, again, not overnight, but they'll just disappear in the same way that we talked about Starlink using stable coins to establish commercial relationships in 100 plus countries at the push of a button. You should be able to do that on the investment side. And it'll take some time. It'll take some regulatory action. But now that we have a pro-crypto administration in the US and pro-crypto administrations in more countries, I think you'll see us get there maybe faster than most people think.
I want to ask you also this. So, I brought up some key points that a lot of investors have brought up to me, but I want to ask you, are there any misconceptions in the market or myths that you realize that people are just, it's convoluted, or there might be misquoted, or there might just be misunderstanding around it? Are there any things that you can think of that's been, misconceptions that have been top of mind for you that you like to share?
Oh man, how long do we have? There's so many. I'll call out three. And I think I can explain why they exist. There continues to be this myth that there's a significant use of crypto for criminal activity, particularly around Bitcoin and other assets. That's simply no longer true. The reason it exists is in the very earliest days of Bitcoin, 2011, 2012, it was true because law enforcement couldn't figure out how to track it, couldn't figure out how to enforce against criminal activity. But now they can, and you regularly see that all the time. In fact, the Department of Justice has come out and said that the percentage of use of crypto assets for criminal activity is lower than the percentage of cash, and it's a vanishing fraction of the space. We also see concerns about sort of the ESG element of Bitcoin and other assets. Again, that's been disproved even by folks like the World Bank, who now talk about how Bitcoin is actually enabling renewable energy development, because renewable energy is often in far-flung locations that can't use all of the energy, particularly at night. They can have a Bitcoin miner, which makes it more profitable. So you're seeing it actually accelerate renewable adoption worldwide. And then the third one is just a gut hunch. I don't know that this is true. I have this feeling that people worry that if they somehow buy just a little bit of Bitcoin or a little bit of crypto or a little bit of Ethereum, that something terrible will happen. I've had people who I've been talking to for like 5 or 6 years. Bitcoin's gone up 10,000%, and they're still devoting research hours to buying it. The message I would say is if you put 50 basis points of your portfolio in Bitcoin or in crypto, the most you can lose is 50 basis points. That's just the way math works. It's not like a virus that infects your portfolio. Nothing terrible is going to happen to you. So I still think people have that sort of fear. It's new, it's different, they worry about it. It's just another asset, right? It goes up and down. I think it's going to go up substantially. But you should think of it as that. Like, remove all the heavy weight that surrounds crypto. It's another asset. It's another technology. It's not foreign or dangerous. It's just a thing that's interesting, that's growing really fast, that many of the smartest investors in the world are allocating to. And maybe some other people should as well.
What about crypto is, you said fraud, which is actually, I'm glad you brought that up. What about crypto or the technology itself that it uses that decreases the chance of fraud or the likeliness of fraud?
Yeah, the thing about crypto is that transactions are indelible and you can trace them digitally. So you can literally trace every Bitcoin from here back to when it was first created. The challenge is it's pseudonymous. In other words, it goes from one numerical address to another numerical address. And law enforcement historically didn't know what numerical address belonged to who. But as the industry has matured, as entities like Coinbase and Binance have applied AML KYC to their customers, law enforcement now has the same tools it has in traditional finance to go in and say, actually, the money in this account needs to be frozen, and then a way to back out who's involved with it. So because these transactions are indelible, you can trace them backwards. You can quote unquote follow the money. So it's actually a very poor tool for most crime or fraud. Now, I should say there's a small corner of the crypto world called privacy coins, which use a technology that obscure that and make that impossible. Bitwise doesn't invest in privacy coins, and I think there's a high probability that regulators won't allow those in any meaningful format. But for the vast majority of this market, because you can trace transactions, because you can follow the money, it's just not a good tool for crime. And people, I think, are figuring that out.
Does that also apply to smart contracts? Because it leverages the same like baseline blockchain technology, correct?
It's the same basic thing. Yeah, you can trace the money in the same way that a traditional bank account is not as good for crime as cash. Crypto is not as good as for crime as cash as well. If we really want to like prosecute crime, we should get rid of cash, which I'm not recommending, but I do think that law enforcement has come around to the view that, of course, crypto can be used fraudulently, and of course there are fraud, of course, everything, but it's not any worse. In fact, it's better than the traditional financial system on most metrics.
Yeah. When you're, I'm wondering on this as well because as we evolve, I mean, this has been an evolving space since, gosh, when did crypto or Bitcoin get
Yeah,
on the
15 years ago. Yeah, yeah,
15? Is that what it was? Okay,
yeah.
so there's been such a huge evolution, but also there's been a lot of just like with anything, right? With any early startup or with any new country or whatever, right? There's bad apples and there's growing pains, if you will, right?
Hmm.
And I think one of the biggest ones was FTX. And what was interesting about FTX, it wasn't just the coin itself, it was the platform that was used, right? Now, again, there's a lot of things that we could dive into that. That's a whole nother animal. But one of the biggest things is acknowledging, okay, you have to leverage platforms that are regulated, that are obviously sustainable long term, and that won't go under, right? And that's one of the reasons why I think there's still a lot of security around banks,
Hmm.
even though they're very regulated, and it's hard to move money. And we've just talked about that. But also, you have that security knowing, okay, hey, look, that money is in there, and even then, we even see like Silicon Valley Bank, there's a lot of
Right.
money, so it's not easy. That's a whole other situation. So I'm curious. I want to ask you, get your perspective on using the right platforms or leveraging the right platforms to make sure that long term, um, you know, you avoid an FTX. And obviously, you guys
Yeah.
did, but I just want to get your perspective on it.
No, it's really important. Look, there's some signals out there that you can use to avoid things. One of which is just your gut hunch. So if something sounds too good to be true, it's probably too good to be true, and that would have helped you avoid a lot of the blowups in crypto. If someone's advertising risk-free returns of 50% a year, no, that's not the way the world works. There's nothing about crypto that you know creates magic internet money that only goes up. That's just not the way the world works. The other thing I would look at as a signal is if it's providing a basic service, but it's an offshore exchange located in a jurisdiction that you're not familiar with or haven't interacted with, that's probably a red flag, right? A US regulated crypto exchange is probably more secure than one regulated in Bermuda that doesn't have a US presence. Now, there's nothing wrong with offshore investment accounts, and that's a big part of the business. And they're well established locales like the Caymans and others with strong regulatory environments. All of that's true. And you have to use them for certain kinds of investments, and it's the most efficient. And Bitwise uses those for certain futures-based accounts and things like that. But for basic services that you can get in a US regulated entity, just have your radar up if you're dealing with an offshore thing. The other thing I would add is, the Lindy rule really matters here. Particularly in crypto, companies that have been around for more than 5 years, who have lived through bull and bear markets, that's a very good sign. Coinbase has been around for, more than a decade. Bitwise has been around for 8 years now. Grayscale has been around for 10 plus years. These are companies that have proven that they can exist through bull and bear markets. And that's a pretty good signal. So if you can get a US regulated company that's lived through bull and bear market cycles, those are good signals. And if you don't have that, you should just do a little bit more due diligence.
Yeah, crazy story. We had some money and a while back in FTX on their platform, and I was just like, we're not doing anything with this money. Let's just wire it back to our accounts. And then I think week and a half later, then everything came out with FTX. And I was like, dude, that's crazy. That wasn't a lot of money, but I was like, dude, that's crazy.
That is
It,
crazy.
it was it was the funniest thing. And then speaking of like what you said, when you have like Bernie Madoff year-over-year growth, projections or whatever, and there's something fishy going on, right? That's where you start. Okay, this is impossible. So, Matt, I appreciate you being on here big time. Really, just talking about these myths, talking about these misconceptions in this industry, how we're navigating this as well, I think is extremely important. And at the end of the day, it's just really saying, okay, this is an asset. This is a very viable asset. Obviously, institutional money is going into it, but how are we navigating it, right? And how like you mentioned as well, make sure that we have the right portfolio construction around it. We're not putting 20, 30% of it. We're putting 1 to 5% consistently. And like you said, it's just a disciplined structure and over extrapolate that over a long period of time and getting exposure. For those that want to just maybe read your book or follow you or do some other stuff and engage with what you got going on, Matt, how do they reach out to you, my man?
Yeah, two things I would say. You can follow me on Twitter. It's Matt_Hougan. My name's spelled funny. It's Hougan. So look out for that weird U. I have no explanation for why it's there, but there you go. Or if you go to bitwiseinvestments.com, I write a weekly memo called my CIO memo. It's short. It's about 600, 700 words once a week. And that's one good way to stay up with what's the most important thing going on in crypto. But this has been really fun. Thanks for having me on.
Guys, that is my guest, the Chief Investment Officer at Bitwise Asset Management, the one and only Matt Hougan. Guys, that is Journey with Christian David's podcast. Until next time, be uncommon if you can.